What is going on, investors? Hopefully, you guys are having a great day out there. Time to talk about Uber Technologies, ticker symbol Uber. Over the last year, this stock is up just 93%. Year to date, up 4% on this one. This company just reported their Q1 earnings. We'll jump into those here in a moment. We talked about over the last year with Uber how they've really had to shift, and they've done it actually quite nicely, shifted from your traditional ride-hailing business more to delivery, food delivery, and that type of thing. We'll see how that transition is still going and talk broadly about that moving forward. Then we'll jump over to the numbers. We'll take a look at the cash, the profit, the expenses, those types of things, see how Uber is doing from a financial perspective. And then we'll jump over to the stock chart and take a look at what's going on over there. Now, Uber reported their Q1 earnings, and unfortunately, they missed on revenue, but they did beat on the EPS side. Now, also, unfortunately, at least for Uber and Lyft in terms of companies, President Joe Biden withdrew a rule that made it harder for gig workers to get benefits. So during the Trump administration, they passed an independent contractor rule, which actually made it a little bit harder for gig workers to get minimum wage and basic benefits and those types of things. Now, here's the deal. This rule was in place, but it didn't really do a whole lot because, as the Lyft president and co-founder correctly asserted on CNBC today, that it's really the states and local governments that control these types of laws, not necessarily the federal government. Now, the federal government could pass some laws and do that type of things, but it would likely take a fair amount of political capital. We've also seen out here in California, which is known for have very liberal policies. Well, it got rejected. A law that was on the proposition ballot got rejected by voters to classify Uber and Lyft drivers as employees and give them benefits and healthcare and those types of things. Let's face it. The drivers for Uber and Lyft don't want to be considered employees. That's what's attractive about the job. But you see politicians kind of jump in on this thing. It looks good for them. It's something that they might be able to campaign or raise money on. But all of this is mainly for show. But companies like Uber and Lyft do have to deal with this type of thing. Now, Uber will invest $250 million in driver incentives to meet improving demand. Here's the challenge with an Uber business, okay? It's a two-pronged marketing business, okay? They have to market to customers that need a ride or need to have food delivered or something delivered. They also have to advertise for drivers to want to deliver that. So they have two customers, the drivers and the people that the drivers are driving around. And here's the deal. We are seeing improving demand from the buy side, from the people that need a ride, people that need food delivery. Unfortunately, the driver supply is absolutely dried up. If you're out here in California like me and you occasionally need an Uber, well, it's been extraordinarily difficult to find one unless you're in one of the biggest cities in California. Just the supply side on that end has completely dried up. Well, no, Uber's going to make incentives by paying these driver stimulus bonuses in order to get more drivers on the road. We'll see if that's effective, but it certainly will affect proper profitability. Now, Uber spins off its Postmates robotic delivery unit in a profitability push. We talked about this yesterday on our Lyft video, how both of these companies have basically spun off and gotten rid of their robotic and autonomous driving units, which was kind of like one of the reasons to buy these stocks because, look, they've got to put all this money into attracting drivers. They've got administrations and governments trying to classify their employees as, full-time employees with benefits and time off and all this stuff. It's a difficult business. It sure would be a heck of a lot easier if you could just have a robots and autonomous cars deliver this stuff. But what's interesting is Uber and Lyft have basically decided to get out of that business in order to make their profits and their balance sheets look better. In the short term, it probably is appeasing investors. In the long term, you have to question that strategy, in my opinion. Now, this goes back a ways. This is back in February. Most of you guys probably already know this, but I do want to talk about this as Uber acquired alcohol delivery service Drizzly for, just $1.1 billion. So Uber's starting to roll things up. They got Postmates, they got Drizzly. They're starting to roll up this business, which I actually think is a good strategy. because it is kind of like a commodity business, okay? What's stopping Apple or Tesla or Amazon or Facebook or any of these other companies to set up an app just like Uber? So the larger they can get their reach, the larger footprint that they have, probably the better they can be at knocking down competition that could potentially come down the pike. So we'll see what happens with alcohol delivery. But I know for a fact, well, myself is not a drinker. I don't drink at all. But I know for a fact I have friends that while they have been drinking at home and have been enjoying that, many of them are looking to go out instead of having drinks delivered. So we'll see the trends on that. Now, speaking of trends, delivery has been absolutely on fire. We've got our 3 months ended here. On the right-hand side is 2021. On the left-hand side is 2020. We're still seeing mobility, which is your traditional ride-hailing business. That is still down a lot, down 30% year over year on a quarterly basis. Now, what's good is this delivery business, which is like Uber Eats and things like that, that is up, just 166% over the last year. And so broadly, we'll talk about like reopening. So we should see that these mobility numbers start to come back. They've obviously got easy comps heading into the summer and the winter time. The business completely fell off a cliff. And so they should be able to beat those types of numbers that they put up this time last year. Now, what's going to be increasingly difficult is to keep up this delivery business momentum, because as people go back to restaurants to eat in person, maybe food delivery is a little stale, so to speak, at this time. Now, freight is up 52%, but it's still a minor part of the business. Let's jump over to the broader numbers, and then we'll jump over to the stock chart as well. Beginning of the year is the left-hand column. The most recent quarter is the right-hand column. We see cash and cash equivalents have bled out of this company a little bit. You're at $6.7 billion. Now you're at, we'll call that $5.6 billion. We got to assume the acquisition of Drizzly and things like that have bled some cash out of this business. Now, in terms of total assets, basically flat from the beginning of the year, and same with total liability as well. You got a little bit of long-term debt sitting on the balance sheet on this one, but nothing really super to be concerned about there on the balance sheet. All things being considered, looking fairly decent. Now, we've got the 3 months ended here. Left-hand side is 2020. Right-hand side is 2021. We've got our revenue coming in from 3.2 billion down to 2.9. So we're still seeing declining revenues in this one. And we got our cost of revenues here. Now, this is what's somewhat troubling. Okay, on $3.2 billion we spent, we'll call that 1.5. So our revenue went down by about, we'll call that 340 million or so. Well, our cost of revenue actually went up. It went up to $1.7 billion. So it's costing them even more to maintain the revenue that they already had. In fact, it's actually down a little bit. Operation and support came in basically flat. Sales and marketing up. So not only is they have to pay more for declining revenues in terms of cost of revenue, so their gross margins are shrinking, their sales and marketing budget went up by over $300 million over the last year as well. So they're going to have to market more for less gross margin. That's a problem. Research and development down slightly. General administrative down a lot. So they've done a lot of fat cutting there, and you've got some depreciation on here as well, which is typically non-cash. Now, you got your total costs and expenses basically flat. So we talked about how some of these went up, some of them went down. They've done a nice job basically keeping those flat, but unfortunately, when your revenues go down, guess what's going to go up? Your loss from operations. Last year, they lost $1.2 billion. This quarter, they lost $1.5 billion. How is Uber going to be profitable in 2021? Like the CEO says, my guess is he's looking at it from an adjusted basis. But I tell you what, there's not a lot of adjusting you're going to be doing here unless you really increase these revenues and expand these gross margins, which I think is going to be difficult for Uber to do. Now, on an earnings per share basis, they lost 6 cents. They had some benefit from, they had some other income come in. I think they've divested out of some businesses. So they had this income come in and it has impacted their EPS. That's why we typically stop at this loss per operations, at least on companies like this, because I just want to see how the operating business is doing. And in this case, we've got declining revenue, declining gross margins, and increasing loss from operations. my opinion, that's not a great recipe. Now, to get an even broader story, a broader picture of that, is you're going to come over here to cash flows. Left-hand side is last year, right-hand column is this year. You pull down this net loss, but you get to add back in stuff, and you get to take stuff away. All things being considered, our net cash used in operating activities accelerated from $463 million up to a loss of $611 million. So losses are accelerating, margins are decreasing, revenues are decreasing. Now, I guess you could look on the other side of the fence and the grass can be really green, because you can say, well, look, the mobility business should come back. You got office traffic. Those types of things should come back. But all things being considered, this wasn't a great quarter, in my opinion, for Uber. Now, the stock is moving in the after hours. Looks like it's trading down a little bit lower than when I started looking at this video. Some very, very key levels here with the stock. This stock, at least on this top range here, we've been trading sideways since November on this one. Now, what I want to point to you, if you want to look at the video right now, if you're listening to this, or if I've got your attention, look at these candles here that I'm kind of circling my mouse around. Okay, it comes from like all the way down here at 36 up to 48. That's like $12. Okay, there's not a lot of candles here, okay? This is like a rock skipping across water, and then it found its footing up here at 49, which is, hey, great. If you bought this stock down here at 34, that's great, you know, and the stock has held this level from 49 all the way up to 62 since back in November. But unfortunately, as we come down with this stock, we made a high here, made a lower high, kind of pump faked it here, but now we're making a lower high, a lower high. Same with the lows. Here's a low, a higher low, but unfortunately we broke that trend. The stock, at least in the shorter term, has broken trend and is looking negative. Now, here's the big risk that I see with this one. You do have some support right where the stock is right now, right about $51, $51.50. This is a logical spot where the stock would take a breath because it's acted as support several times since November. Now, even lower than that, you have this $49 level, but I would say that is like hanging off a cliff. Okay, you got to have balls of titanium to step in here at 49. Now, it's a logical spot because 49 has proven to be areas of support over the last several months as well. But what I pointed out to you in the beginning was we have very, very sparse price action underneath this. If this stock breaks 49, I tell you what, you have a relatively high probability of cutting through this like a knife through butter and coming all the way down here, probably into the 40s, maybe even the high 30s on this stock. So that's what would have me concerned. I'm not saying that could happen, but I'm saying that is certainly a possibility with this stock because, like I said, we've pretty much broke any kind of uptrend that we had over the last few days. And now that we've had Q1 earnings come out, and they haven't popped the stock to the upside, we'll see what happens with Uber. So, all in all, I think the business is under some pressure. I am curious to see how the mobility, the traditional ride-hailing business comes back, and I'm actually interested to see how well the delivery business holds up, considering people might want to go out for a drink or out to dinner more than they had over the last year. We'll see what happens with Uber. I think it's kind of a wait-and-see stock. The stock has pulled forward a ton of gains over the last year, and you're essentially buying an app on a phone. They do not have any more proprietary technology when it comes to autonomous driving and it comes to robotic delivery. They do have some minority stakes in those businesses, but it used to be a bigger part of the story over here at Uber. So we'll see what happens with this one. Declining revenues to declining gross margins, and you got a $98 billion market cap. Tell you what, the market's a little frothy right now. Wouldn't look to jump in on this one. Hopefully you guys enjoyed this video. We'll be back with more, of course, in the future. Good luck with your investments.